Hey guys, welcome back to the channel. In today's video, we're going to be talking about a recession, or as a lot of people are saying, are we headed for a Richcession? So a little bit different than a recession. Why the wealthiest stand to lose the most if the economy continues to stall. Now, as we know right now, guys, the Federal Reserve has raised interest rates 0.25%, which brings the Fed's fund rate to 5%. Now, the tightening of the job market has really driven a lot of companies to lay off people. Recession works when we are really outsizing impact on the working and the middle class, which again, we have seen a lot of jobs that have been cut, but the wealthiest could see the biggest hit to the wallet if the recession happens in 2023. And we're going to cover it. This is an article that is over on Forbes that I do want to cover. I was reading through it today and I love the information that they provide in there. So what is a Richcession? So according to the National Bureau of Economic Research, the economy isn't actually in a recession as of today. Last recession to be declared was 2020, and that was at the very beginning of the pandemic. So it has been 3 years since we have seen an actual recession per the NBER in this pretty much this decade. If the US heads for a recession in 2023, it is possible we'll see what is called a Richcession. Increased or mostly impacting the working and middle class, a Richcession has a more noticeable effect on the finances of the upper class. Now, why does this happen, guys? We're going to go through again a couple things and a couple reasons why this happens. So how would it impact the rich? When a recession is on the horizon, the rich don't have to really worry about it. They're in a good financial position. They ride out the rough economic times. They can get through it. But there are really two key reasons why this could be different than what we have seen in the past. Number one, the white collar layoffs. So in 2022, we've seen thousands of tech companies laying off workers, many of them being high earners. When you look at engineers, when you look at higher developmental positions, even leadership positions in tech companies, over 2022, they laid off almost 150,000 workers. And most of those were tech workers that were laid off as they cut kind of that tech industry. White collar workers, higher paychecks, meaning 100,000 or 100,000 plus, 120,000 plus. As more tech companies continue laying off workers into 2023, money for the rich gets a little bit tighter, who has been pushed out of high income jobs. Now, a lot of the jobs, according, again, when we see the jobs report, a lot of jobs are still being created, but there is a point where, again, a lot of companies are laying off people that are in the higher white collar echelon. Caveat here is that generally high income workers have transferable skills, more likely to find another job. But when we have a wide layoff across the market, that is where it gets very difficult, because jobs might not be readily available for all of these tech and other industries that are seeing layoffs. Now, second part, guys, is the stock market. Household net of the rich include a healthy or very healthy large investment portfolio. Many investors choose to have at least a portfolio, a big majority of a portfolio in a stock market. Plummeting stocks like we've seen coming out of 2022 makes a really big difference. So as recession fears continue, it's no secret the stock market has taken an absolute hit. When you combine the layoff in the job market with a decrease in the stock market, this could leave wealthier people in a more precarious situation than we have seen in any past recessions. Now, recessions do affect everybody, which again, we're going to get into. Number one being the higher inflation, guys. If you have looked at the consumer price index, if you looked at the cost of vehicles, it's been kind of incredible how much you're spending almost on an average monthly income basis. Income might go up slightly, but the prices are going up astronomical, and that is where inflation impacts everybody. Higher inflation means it's more expensive to purchase anything, a home, a car, even your credit card debt. The monthly average payments will continue to increase as the financial burden increases, as the interest rates increase. Anything that is variable rates, you are going to see a pinch on the wallet. Now, higher interest rates, with inflation still being hot, the Federal Reserve has not really stated that they're done raising interest rates yet. So we could see, 5.25, we could see 5.5, making it more expensive to borrow. When you look again, mortgages, when you look at cars, when you look at anything that is variable, it is more expensive than it was 12 months ago. If you're looking to make major purchases, a lot of people are holding off on it. This is by design, guys. as the interest rates continue to increase, it slows down the economy. Higher interest rates mean higher price tags for items because you have that built-in interest, which means, again, if you're looking for a new home or vehicle, you might have to just suck it up for a little bit till everything kind of levels out, the prices get good, and then the rates come down a little bit to really make that purchase. Or if you are going ahead and purchasing it now, looking at refinancing it in the future. Now, one of the saving graces that has not or really kept us from going into a recession as of now is the job market. We have still seen a lot more job growth than we have in the past. So the economy overall, even though inflation is high, CPI is high, the strength of the economy is pretty solid overall, especially because, I mean, if we had issues where there's no new job creation, we'd probably be far worse off than we are now. So how can you prepare for this recession, guys? Or if we see it the Richcession, or if we see it really at all, really not fun experience, not fun times for anyone, but there are a lot of things that we have talked about on this channel that you can really prepare. Number one, building up that emergency fund, 3 to 6 months at minimum, possibly even having a little bit more now, just as a buffer, because we know if rates do continue to increase, if you do have to buy something, it is going to be more expensive. So just building in a little bit of an extra buffer into that emergency fund until the economy kind of settled down, the job market settled down, and prices kind of come back to a stabilized normal expense. Now, the big one, guys, is our second point: cutting down discretionary purchases. This is where you really tighten up the belt. If you can start cutting unnecessary things out of your budget, it will help build up that emergency fund much faster. And if something does happen with your financial situation, it is a lot easier to recover. This is one of the big reasons why I always say saving for an emergency fund and then the elimination of debt. If something happens, such as a job loss, or if the economy, really comes off the rails, you can be prepared for it because the monthly liabilities are much lower, meaning that all of your income is not going to be spoken for. And the final one, guys, keeping the resume on standby. Might be a time to dust it off, might be a time to update it just to see exactly what is coming. Worst case scenario, you're prepared, which is always a good thing. So if a recession is coming, really at the bottom line, it affects the rich just like it does everyone else. But depending where you are on the financial spectrum, now is the time to really beef up the savings accounts. Make sure that you have some room just in case everything, really does hit the fan, and making sure, again, that you are prepared for what could be coming. Sorry, guys, so that'll do it for today's video. If you like the content that I provide, go ahead and click the subscribe button. And as always, thank you guys for watching.